Paul, I'm gonna shift over to you. You obviously have watched the activists at work. There were some lessons learned. Your views on long-term, short-term share price and whatnot for our audience.
I've been on both sides of the story here, both on the receiving end and along with the activist slates on the I won't say attack end, but the investor construction end of the business. But a couple of comments to start. One is boards don't run companies. That's one of the things that the question we have to ask ourselves as directors is, how are we holding management accountable for delivering on the promise? So is the makeup of the board such that it will work constructively, but at the same time be able to ask the right question and ensure that management is delivering this in the long term? When interacting with shareholders, it's kind of tricky because who speaks for the company versus who speaks for the board, and who actually runs the company? Management runs the company, in my view. So you have to be very careful about how you do that. What directors should be doing is listening, not trying to sell the story, but understanding what and how shareholders perceive the company's doing. And when you go to those meetings and the share price is at an all-time high, they're pretty friendly meetings. And so the impact of share price is enormous on how the company is perceived and operating. The share price has gone not only in absolute terms, but in relative terms to benchmarks and to competitors. The share price is way down, then those meetings are a little bit tricky. It's kind of like when my kids brought home A's, you know, they could be late on Friday nights, but when they brought home C's, it's another story. So that's one comment that I would caution people on, is the presumption that directors get too involved in management of the company when they're not management. The other thing, just as an opening comment, that institutional investors are by far and away the largest investors in activists. So the institutional guys might say, well, I want long term, but in point of fact, they are the ones that not only invest as limited partners, but follow the investments very closely of what the activists do in kind of how they manage their portfolios, or where they buy stock or not, or momentum and so on. So the impact that it has of activists is very much aligned with, and very much the institutional so-called long-term investors are much aligned with them. So now we look at what kind of shareholders are these guys, and what kind of shareholders do companies want? And the big point of that, I think, is it's that famous line that in a democracy, voters get the governments they deserve. And in companies, it can very much say the same thing, that companies get the shareholders they deserve. And if management breaks faith with the shareholder in communicating and having an understanding of what it is that the company is going to achieve, and in fact they don't deliver on that, and the boards accept these yeah buts, yeah but it's snowing, or yeah but this happens, or so on, then in fact shareholders will say, wait a minute, these guys aren't delivering on the promise. They've broken faith with me, and the reason I invested in the first time, I'm going to vote with my feet. As a result, the share price will go down, and that's the gap that Wes was talking about, which invites the activists to the table to say, wait a minute, these guys aren't delivering on the promise. There's all sorts of value here that's not being realized, and this management team is not being held accountable by its board of directors to deliver on that. So this is what gives rise to activism, and I say activism is a good thing. People decry it and say it's terrible, but in fact institutional investors are voting or investing in activists because they deliver on performance. They do make a difference. They do enormous amounts of homework, and they're really smart. As a board member, though, I can tell you that these guys kind of march to a different drummer, that they can be very upsetting. So do you really want these guys at your table? And I would say no. And the best defense is to make sure that management is delivering on the promise, and that they're holding themselves, management accountable to their shareholders over a long-term period of time. Otherwise, you'll see it in the share price. What's the big alert thing that's going to come as directors? That your share price is going down, not only in absolute terms, but especially in relative terms. And if you can't explain the difference, then you are in big trouble. So my lessons from the trenches on this one is, and these are fundamental things that companies should be doing anyway, and directors should be holding management accountable anyway. And you call it a defense, I think it's just managing appropriately. The first thing, if you look at companies that last a long time, and have been in the business for a long time, it's balance sheet strength. Companies that don't fall prey to over-leverage when the going is good. Edward VIII was famously said he was good when the going was good. And it's going tough. And look at the debt issues now in the energy sector in Western Canada. It's because they don't have the wherewithal to last it out. And the push comes from some to say, why aren't you levering up? Why aren't you doing a share buyback? Why aren't you, in fact, utilizing your balance sheet more effectively? Well, that's good when the going is good, but it's not very good when the going is bad. Companies that last in the long term and communicate that they have a stringent policy on a strong balance sheet and stick with that, despite the vagaries of sentiment at the time. That the companies are organized appropriately through to the CEO and then up to the board. And I think that my view is hierarchical command structures, if you want to use that term, almost military. Committees don't really work. Matrix reporting is very difficult. Who's in charge? And do you have a clear line of accountability from person in front of the customer up to the CEO, to the board, and then ultimately to the owners of the company? Shareholders, I like to think of as owners. And if they own the company, then we have an obligation to deliver to them on a regular basis. Does the company absolutely understand what it is that they're selling? Services, gizmos, electric cars, whatever. If they have, and delivering to what companies want, or individuals want, I should say, the buyers, whatever that may be, at a price they think it's worth. Do they really understand that? And we talk about short-term, long-term. If you're subject to a disruptive new technology, everything becomes very short-term. So understanding what your customers want, that you have the right people that absolutely know what they're talking about and are incented for the long-term value of the company. This is the alignment of interest thing. And if you have the wrong kind of incentive plan, you're going to get what you pay for. You hang that carrot up, people are going to respond to it in their self-interest. If you have a long-term deferred compensation where it's in the interest of the employees and the management to stick with this company for the long term, then you'll have long-term growth, and you'll have people thinking in the long term and communicating that very importantly. You might have something we talked about a little bit now is a disconnect between the portfolio manager, which is measured on where he or she is doing relative to the index, to operating management, which are paid for the long term. So you might have a disconnect there in the sense of how institutional investors, supposedly long-termers, are paying people and how they're responding to short-term vagaries of the market. And lastly, it's absolutely important that you absolutely know what's important. That is, are you looking at what you need to know when you need to know it? And is that information actionable, accurate, universally understood? And especially, is it universally understood? Are you communicating what the benchmarks are to your shareholders? Say, these are the things we watch, this is what's really important, and it's measured against our own benchmarks as well as our competitors. So that, in fact, you have an anchoring of what's key to the company's success. And everybody understands that, and you pay for it. If you hit those marks, we'll give you X, and that should turn into a prolonged positive share price. So this quarter-to-quarter stuff, actually, I'm okay with it. If, in fact, people want to see how we're progressing, certainly as management, some stuff you want to see weekly. So as owners of the company, it's certainly fair to show quarterly. And is the company progressing along the track that it's supposed to? If it's not, do you have a good communication understanding of your shareholders that you can explain it for outside impact, or it snowed or something happened in the quarter to explain it, then they'll stick with you. If in fact you don't have confidence, in fact the information is all over the block, and you're not focusing on this, and you're subject to the massive amounts of dumb stuff that comes through media and newspapers and talking heads, then you're subject to getting off track. So I would say that those key things, as a director, if you're sitting back and making sure that you're cognizant of focus on what the shareholders are, what's really important, and you're keeping track of it. And if it's not happening, your job is to make sure that it does, and the way you do that is to change management. So the presumption is You've got to go in and you've got to have the wherewithal and the will to truly hold management accountable for delivering on time. And if they don't, then you've got to change. And if there's one fault we would have is people get too friendly. The collegial nature of the board, and they put up with yeah buts. And I would submit that that's one of the big issues that happened in Canadian Pacific, that they just put up with that too long. The gap opened up to such a point that really smart guys come in and say, wait a minute, I can get management to do better. The last point on that, what Bill Ackman did that was the key to that success was bring in Hunter Harrison. Bill Ackman doesn't run the company. Hunter Harrison runs the company. On the other hand, there's a story of J.C. Penney, which didn't go right well because he didn't have the right CEO. So I'll end it on that one.